All right, so let's begin the show. And when it comes to financial planning or maybe planning your investments, a common advice that we hear from experts is that you need to first have your core portfolio ready, and then maybe you can look at diversification. And when it comes to diversification, you can look at diversifying into different themes or sectors. Now, talking about sectors, healthcare or pharma as a sector has been on radar for a lot of AMCs lately. And so today on the Money Show, we are focusing on Kotak Healthcare Fund. The NFO actually closes on 4th December. Let's discuss more on this. I have with me Shibani Sircar Kurian, Senior Executive Vice President, Fund Manager, Head Equity Research, Kotak Mahindra Asset Management. Shibani, good evening and welcome to the show. And yes, we're going to talk about the healthcare sector and immense potential, when we talk about the Indian healthcare industry. But one point in concern is also the kind of transition that this entire sector is witnessing, Shibani. Now, looking at the transition, how do you decode this? And also, so the timing of the NFO, what's the crucial aspect of this transition that can be of benefit for our viewers and investors, if at all, wanting to have this kind of a fund in their portfolio?
Yeah, absolutely. So you are right. The healthcare sector of today is not the same as what it was, say, maybe 4, 5 years ago. Now, as we know that, our population globally is aging, and as life expectancy is increasing, there is requirement for affordable but high quality healthcare, and therefore the opportunity set that this sector provides is structural in nature. Now, for Indian pharma industry, what started out as companies manufacturing in the domestic space in terms of branded formulations and then exporting to the rest of the world, especially where generic drugs are concerned. Today, the sector has become extremely diverse. So it's no longer just limited to the export opportunity in terms of generics or the domestic play. You have many companies which are now diversifying and moving up the value chain, looking at specialty pharma portfolios and drugs in that space, which are again critical medicine, which is high margin in business, in nature. We have companies which are part of the CDMO space, which is called contract development and manufacturing, which is also a large opportunity set. And finally, companies which are looking at API manufacturing as well. So this is the pharma industry. But when you look at healthcare as a sector, the sector is even more diverse. As over the last 3, 4 years, you've seen significant number of new companies that have come for listing, especially in the hospital segment, diagnostic health insurance. So therefore, we believe that overall, healthcare as a space in terms of the growth opportunity set remains fairly large and intact. Indian companies are very well placed in the global generics exports market and occupies a significant share. And third, and most importantly, companies are moving up the value chain in terms of the kind of product portfolios that they enjoy. And many new listings have happened across in the healthcare space, which makes the opportunity set fairly large.
Shabani, also considering the entire concept of health, which is also changing in the country, and the brighter prospects also of the sector that you just highlighted. Now, keeping all of these things in mind, I really want to understand, the kind of exposure across market caps you might be wanting to have in this particular fund, and in terms of entire healthcare sector, what would be the specific companies that you might be looking at or would be on your radar?
Absolutely. In terms of construct of the portfolio, we will go bottom up in trying to identify companies. We will follow what we call internally as a model, which is known as the BMV model, which is essentially business management and valuation. So in terms of business in the sector, we will try to identify companies with a product portfolio or an approval pipeline, which will help in terms of growth ahead of the industry. And that growth should be scalable and sustainable in nature. We will also focus significantly on the corporate governance practices and management quality in terms of their ability to meet their strategic targets and their vision, and of course, accounting policies. So that's going to be a key area. And third is going to be valuation, where we will look at growth opportunities, but clearly at reasonable valuation. So this is a model that we will employ in terms of identifying companies across these different segments that we discussed earlier. Now, what you're rightly saying is that, if you look at the entire pharma healthcare space, the space itself has evolved significantly. Today, if you look at the segment per se, the domestic business, which is the branded formulations business in India, has been growing at a pretty steady pace of about 10 to 12%. And therefore, that's been a steady area of growth. What has also turned around on the US generics business is that price erosion has now moderated and has become pretty much single digit, low single digit from the mid-teens price erosion that we saw some years ago. So competitive intensity has come off, which means profitability has improved. And also many companies are now looking at specialty pharma portfolios, where again there is a big opportunity set and where profitability is large. So I think the way we will look at this portfolio, there will be no constraint in terms of market capitalization. We will have an approach to be market cap agnostic and look at construct of the portfolio on a more bottom-up basis.
All right. Now, these kind of companies or exposure would be there in different kind of category funds also. How would you advise our investors to be placed in this particular sector, if at all, using this kind of a strategy to diversify their portfolio?
So absolutely. But one point I wanted to make here is that if you look at the frontline indices, say look at Nifty 50, Nifty 100, or even the broad index such as NSE 500, the pharma sector weight or healthcare weight in these indices is actually low single digits or mid single digit. And therefore, a diversified fund, assuming even if they were overweight on the sector, would not have a significant exposure from that perspective because the benchmark weights are fairly low. And therefore, what we believe is that given the structural opportunity, if somebody wants to have an exposure to the healthcare space in the overall equity asset allocation bucket, make way for a pure play healthcare fund and therefore play the healthcare sector through that kind of a product, which is what we are launching at this point in time. So what we are also saying is that if you're looking at from a valuation perspective, of course, the growth opportunity set is well known and is structural in nature. The healthcare space in terms of valuations are also trading at multiples which are in line with long-term averages, and therefore valuations are reasonable as well. And therefore, somebody who wants to invest for a slightly longer period of time to benefit from the structural opportunity can look at a pure play healthcare fund in his overall equity asset allocation bucket.
All right. I think that will be all. Thank you so much, Shibani, for taking time out and helping our viewers with their strategy in healthcare space. Thank you so much.
Thank you so much.
Welcome back. You're watching the Money Show with me, Kavita Thaplayal, and there are plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should be looking at to help you navigate through this maze? Today I have with me Pankaj Matpal, MD, Optima Money Managers, and also do not forget to send us your queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyShow@etnow.tv. Pankaj, good evening and welcome to the show. We will take Praveen's question first, and Praveen writes that his goal is to... do I have Praveen on the phone line with me? Praveen,
yeah.
Hi, good evening. How are you doing?
I'm good, how are you?
Thank you so much, Praveen, for sending us your questions. So I believe you want to accumulate a corpus for your retirement in 15 years. And you're investing since last 1 year by SIP, and you have Parag Parikh Flexi Cap, Quant Mid Cap, Kotak Emerging Equity. You also have Nippon India Small Cap. You have Quant Small Cap, ICICI Pru, Nasdaq as well. All right, so this portfolio is made in last 1 year, or you've staggered this investment and it's only one after the another that you've added this fund?
No, staggered from the last 1 year, and I try to sort of diversify across fund houses, market caps and regions. Currently it's going via SIP. But my question is, is there any changes that is needed in the portfolio? Yeah.
Sure. So I just want to understand, Praveen, will you be stepping up your SIP amount, and what's exactly the amount of corpus that you want to accumulate for your retirement?
Don't have anything specific number in my mind, but I would like to step up. I don't know how much, but of course I would like to step up over a period of time.
Sure, and that step up would be like 10% every year, is that so?
Yeah, approximately, yeah.
All right. So Pankaj, roughly, before I get into the nitty-gritties of the fund, I just want to understand the amount of corpus. If at all he steps up 10% every year, what will be the approximate amount that he can accumulate in 15 years with this kind of an investment?
Kavita, good evening. See, he has been investing for last 1 year, and if you see 30,000 rupees per month, and if we assume again CAGR of 12% and step up of 10% every year, he can expect around 2.48 crores in 15 years. And if it did not step up, then it is around 1.43 crores. So you can see the difference. So as Praveen, you agreed to step up your investment, it will really be helpful. And I'll suggest, because over a period of time, money loses its value. So you should try to step up as much as possible from time to time.
All right. So Pankaj, let's also talk about the fund mix. He's been investing since almost a year. So what are the funds that you would want him to exit?
Kavita, he does not need to exit any fund. He doesn't need to add any fund. It's a very good portfolio across the market segment and across the geography. Means he has also added ICICI Prudential Nasdaq 100, which is a good diversified international fund. And plus he has large cap, mid cap, small cap, flexi cap, everything in his portfolio. So all the best to you, Praveen.
All right, so Praveen, that's good news for you. The fund mix looks great, and you want to step up, which is a very good intention. Please stick to it. And 1.4 crores is almost the amount of corpus that you can accumulate with your current investment amount. Is there anything else you want to ask Pankaj?
How about the allocation amount? Is it right? Currently, I spread across 30% across 33% across.
Yeah, and you want to step up also. So you are on track, because we don't have any corpus figure that you want to accumulate. Roughly, Pankaj calculated it for you, so it's going beyond 1.2 crores. So if at all you want more, then you might have to invest more. The funds so far are good. All the best, Praveen. We'll move on. And do I have Vishwajit Kore with me? Vishwajit, hi, good evening. How are you doing?
I am fine.
Thank you so much for sending us your question, Vishwajit. And you've been investing, you and your wife. Both are investing since last 1 month?
Yeah. We both are investing, yeah.
All right. So I think, Pankaj, you do have their portfolio details on you?
Yeah, definitely. Fund mix is good as such. And all the large cap, mid cap, flexi cap, all good funds are there. But as we know, returns are not guaranteed in mutual funds in long term. I always do a calculation with 12% CAGR, though I think he's expecting 15%, which may be possible, but still you should aim to achieve your goal with the 12%. So you should invest accordingly. And you have sectoral fund in your portfolio, which I'll say that you should avoid. Or you want to add sectoral fund, but I'll say that you should avoid, because when you invest in diversified funds, you get exposure to all sectors. And if I calculate at 12% with your investment in 5 years, you can, with the 54,000 per month, around 44 lakh you can accumulate in 5 years. But if the investment horizon is around 10 years, then you can expect around 1.21 crore. At 12%, I have done the calculation for you.
All right. Also, what I want to understand is, so he has a separate portfolio and his wife has a separate portfolio. As a strategy, do you think it's the right strategy to follow, looking at the combined corpus that they want to accumulate? And also, he wants you to suggest him a sector fund, if at all that's needed, and also his international exposure in the US markets.
Yeah. See, I mentioned earlier as well, see, he did not need to add sectoral fund to his portfolio, because the funds which he has, these all are diversified fund. So he is getting exposure to all the sectors. So taking extra exposure to any sector will not be very helpful, and maybe risky also when you don't know that when to exit those sectors. So my suggestion that do not add sectoral fund to your portfolio. And about this thing, what you asked, that husband and wife investing separately, if both have earning, they have their income, then definitely for the common goal also, they should contribute, they should invest separately. And what happens when you invest separately, your all long-term capital gains, short-term capital gains, whatever it is, or interest will be taxable in your hand. So if you both have income, it is always better that you both invest, and goal can be together you want to accumulate some corpus for buying a house or for your retirement, whatever it is. But if you both have income, it is always good that you both should invest.
All right. Let's quickly look at the fund mix also, which Vishwajit has. ICICI Pru Large and Mid Cap, Edelweiss Mid Cap, Kotak Small Cap, Quant Flexi Cap. Vive's portfolio has Nippon India Large Cap, SBI Magnum Mid Cap, SBI Small Cap, Parag Parikh Flexi Cap, ICICI Pru Value and Value Discovery. So, any change do you recommend?
Small cap exposure is little high, and because he has mentioned 5 years, he can invest or may increase his horizon to his time period to 10 years. So if you are considering for Vishwa for 5 years, I'll say that you should avoid small cap fund. If yes, your investment horizon is 10 years and above, then only you should consider small cap. The reason is that volatility is the inherent nature of equity, but with small cap, you can experience it more. So that is why if market corrects, you have time in your hand, you can wait for a longer period. But if you want to invest for a time like 5 years or something, then you should avoid adding small cap fund to your portfolio. So you can reduce your exposure to small cap fund, or you can even avoid them.
Still have Vishwajit on the line with me. Vishwajit, anything else you want to ask Pankaj?
I think he cleared all my doubts. And
sure.
if I
all
wanted
right.
to invest lump sum, then I can invest in these funds only, right?
Sure, Pankaj, if at all lump sum is the sure.
See,
Pankaj, what funds? Yeah.
Because Vishwa, you have small cap fund 2 in your portfolio, and I said that you should avoid them if your investment horizon is not very long. So in this case, can you tell me you want to invest for 5 years, or can you really invest 10 years or more?
Right. All the best, Vishwajit, for your portfolio. We move on, and we'll take Parikshit's question via email. ABSL Focus, UTI Mid Cap, Kotak Emerging Equity, ICICI Pru Multi Cap, Nippon India Multi Cap, SBI Large and Mid Cap, and all SIPs are through a distributor. And he wants to know if he can go to direct from regular. That's a type of schemes he is investing in, and he's been investing in top 2 funds. That means UTI Mid Cap and Aditya Birla Focused since 2017, and he wants to know if he can change them into direct as well. Current value is almost 2.14 lakh, and so yeah, basically he also wants to have a lump sum amount invested. So what should be your recommendation for him, Pankaj?
The first question is very simple, that whether he should switch from regular to direct. If any investor does not need any cooperation from a distributor, whether it's advice or it is a service, then definitely you can consider switching from the regular plan to direct plan. And simply you have to stop your SIP in the regular plan and start fresh SIP in the direct plan. And the existing corpus, if you want to switch from regular to direct, in that case, you have to redeem your units of regular plans and you have to buy units of direct plan. It is like a redemption and then buying. So exit load or capital gain tax may be applicable, so that you can decide whether you need some services of distributor or no, and accordingly you can take your decision. And procedure I have told you. Second thing, Kavita, what lump sum investment I'll suggest that he should invest in a multi-asset allocation fund like ICICI Prudential Multi-Asset Fund, because he has investment otherwise equity. So this multi-asset fund will give him exposure to gold as well as debt, and it's a good fund in this category. So for lump sum, this fund will be good. And also, if his investment horizon is really long, then he has one fund in his portfolio, SBI Large and Mid Cap Fund. He can add some, means he can top up that fund. He can add to that only.
All right, I think that will be all. Thank you so much, Pankaj, for being on the show and helping our viewers with their financial portfolio queries. And time to sign off on the Money Show as well. But then I'm going to leave you with our WhatsApp number and email ID where you can keep sending us your queries, because this is the only show where we do your live financial planning. We give you an opportunity to talk to our financial planner experts and get your financial goals lined up as per your investment strategies. Thank you so much for watching. Goodbye.